Welcome to How to Retire on Time, a show that answers your questions about all things retirement, including income, taxes, Social Security, healthcare, and more. This show is an extension of the book, How to Retire on Time, which you can grab today on Amazon or by going to www.howtoretireontime.com. My name is Mike Decker. I'm the author of the book, How to Retire on Time, but I'm also a licensed financial advisor, insurance agent, and tax professional, which means when it comes to financial topics, we can pretty much talk about it all. Now, that said, please remember this is just a show. Everything you hear should be considered informational, as in not financial advice. If you want personalized financial advice, then request your wealth analysis from my team today by going to www.yourwealthanalysis.com. With me in the studio today is Mr. David Franson. David, thanks for being here.
Yes, glad to be here. It's fun.
David's going to be reading your questions, and I'm going to do my best to answer them. You can send your questions in right now, either by texting them to 913-363-1234. Again, that number, save it in your phone, 913-363-1234, or email them to heymike@howtoretireontime.com. Let's begin.
Hey, Mike, what's the best way to deal with a company stock that has a low basis?
That question's an interesting one. I need more information to answer it.
Okay.
But I see where they're going. This is very common, especially like the Microsoft employees, the Amazon employees, these major companies. I immediately think of Microsoft, Amazon, Apple, Facebook, Meta, tech stocks. They issue these companies holdings. And the information I need in addition to this is, are those stocks held in a qualified account or a non-qualified account?
Okay.
That's jargon, so let me explain it.
Yeah.
A qualified account is an account. It's a retirement account. Think of your 401k. Think of your IRA.
Yeah.
So it's qualified for the retirement benefit, as in you don't pay capital gains on the way up.
Okay. Yeah, it can grow, and then you don't report that growth on your taxes.
Nope. Your CPA has no idea.
Yeah.
Which is nice.
Yeah. Very
Sometimes
nice.
it's nice. Yeah. But the qualified accounts are going to be different in how we handle this than non-qualified accounts. So non-qualified account, think of your brokerage account. You're subject to the capital gains. Okay, so if you were to sell it, you pay the 15%, 20% capital gains, or 0%, depending on your situation. Or if it's short-term, capital gains, you held it less for than a year, you would pay whatever your income tax rate would be. Okay. So let's answer the question in two parts. The easy one is if you have it in a non-qualified account. So it's not a retirement account. That's probably the easiest way to explain it for people.
Okay, yeah.
So the answer is through tax loss harvesting. So just think of it this way. Let's say you've got, 50 securities. You've diversified and you hope most of them go up. And let's say most of them do go up, but there's a couple that lose money. Great. Sell the ones that lost money. Overall, you still made money. And then use the losses that you had in your portfolio and then offset it with the gains that you slowly sell your security in, a non-qualified brokerage account.
Okay.
Because you can offset the losses with gains. So you can slowly get out of that position and better diversify your assets more tax efficiently than you would have otherwise. Okay. It's okay to sell losses. Not all your stocks are winners. That's never going to happen. I shouldn't say never, but you get the idea.
Yeah.
It's highly improbable that every stock you pick is going to always make money.
Right.
I'm being facetious. So that's the first one. Now, the other one, which is very interesting, is if you have it in a qualified account like your 401k.
Okay.
This is going to be very technical. Bear with me, but many people, including financial professionals, do not know about this part of the tax law.
Okay.
It's called an NUA, or a net unrealized appreciated asset. So let me say all that differently. If, let's say Apple or Facebook, whatever, has issued you stocks for the last 30 years, 20 years, 10 years, whatever it is, and you bought them all at a very low basis, and you never sold them in your 401k, technically, you have not realized those gains.
And so what's the low basis again? Is it the...
So let's just say stock XYZ.
Mm-hmm.
You bought it for years at $10 a share. It's now worth $100 a share.
Okay.
And we're going to keep it at one share to keep this really, really simple.
That's appreciated.
So if you were to, in a normal situation, sell that, you're going to pay capital gains on $90. So $10 a share, $90 of gains for the $100 position. That stinks, right?
Yeah.
Well, if you were to sell, let's say you put it all to cash and you sold it and you had a distribution, the $100 wouldn't be taxed in the capital gains rate, which is 0, 15, or 20%. It's taxed at your tax rate, your income tax, because it's a distribution, so it's taxed as income. So what people can do, and many people don't realize this, is you can take the stock itself, assuming your 401k will allow this, and move it over to a non-qualified account. Okay? And you would pay the tax, and there's a lot of nuance to this, so I'm kind of hesitant about even explaining it over the radio. So do not take this word for word. Seek a CPA or someone who understands the tax law, like us at Kedrick. But you could take that highly appreciated asset in your 401k. You can't sell it, but you could move the position into a non-qualified account and then pay income tax on the basis, as in the amount that you bought it at, that low dollar amount for each position over the years. You would pay taxes basically on the basis, move it over, okay? And then when you realize the asset, you're now realizing it underneath a non-qualified or a brokerage account or a capital gains rate.
Okay.
This is complicated stuff.
Yeah, but I think I'm following though, actually.
Yeah, good. Because we didn't even talk about this before the show.
No.
And I don't think you've worked with a client that had to do with this yet. This is tricky.
Yeah.
But I mean, would you rather pay income at your effective tax rate? Let's say it's 20 to 25% at best. But let's say you've got $1 million. So now you're in the high, the 30s percentile rate. Or you could pay it at 15 or 20%.
Oh, yeah, we know the answer.
So when people, and I see the value of this in your 401k, you don't want to be all in on one thing. So you get the stock. The second you could sell it, you diversify. I get that. But there are some people out there that have a highly appreciated stock, as in they bought it for cheap and it grew a lot in their 401k that their companies gave them, that they never sold, whether it was sentimental value or whatever it was, and they held it for a very, 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 very long time.
Mm-hmm.
This is for you. Maybe. A lot of nuance. Has to be done right. Got to time it correctly as well, because you got to make sure it ends up in the long-term capital gains. So you got to hold it for enough period of time. You got to prove that. There's some accounting work that needs to be done. But a lot of money can be saved from this, which is one of the many tax strategies that you wouldn't even think about Googling or asking on ChatGPT. So, yeah, this is the NUA strategy. If you want to do some research on it, Ed Slott is one of the coolest CPAs, nationally recognized. Just look up NUA, so Nancy Umbrella Alpha, for the pilot phonetics or whatever it is.
Yeah.
Net unrealized appreciated asset. NUA, you can look up his work. You can ask ChatGPT how it works. But I do not recommend you going about this on your own. Work with a financial professional, because you want to make sure you do things right. Because if you take one step out of line, it could create a massive tax bomb. And you do not want that happening, especially as you're trying to enter into retirement, preserve assets, and make good and healthy financial decisions. But yeah, this is why people come to us, for advanced tax planning. It's not just IRA to Roth conversions. There are so many other things that you could do. You're listening to How to Retire on Time. That's all the time we've got for the show today. If you enjoyed the show, consider subscribing to it wherever you get your podcast. Just search for How to Retire on Time. Discover if your portfolio is built to weather flat market cycles, or if you're missing tax minimization opportunities that you may not even know exist. Explore strategies that may be able to help you lower your overall risk while potentially increasing your overall growth and lifestyle flexibility. This is not your ordinary financial analysis. Learn more about Your Wealth Analysis and what it could do for you regardless of your age, asset, or target retirement date. Go to www.yourwealthanalysis.com today to learn more and get started.